Wondering where to invest your money in 2024 to grow your wealth? With so many choices, it can be tough to choose between real estate and stocks. In today's video, we'll explore the pros and cons of both investments. We'll discuss why some investors prefer real estate, while others favor the stock market for its potential high returns. Keep watching as we look into these exciting options. You definitely don't want to miss the bonus tips that could boost your finances. Let's first check the pros of real estate. Investing in real estate offers several advantages that make it stand out from other investment options like stocks. One of the main benefits is that real estate is a physical asset. Unlike stocks, which are just pieces of paper or digital entries, real estate consists of actual properties that you can see and touch. This physical presence provides a sense of security for many investors, as it can hold its value over time and can be used in different ways, such as for personal use or rental income. Another big advantage of real estate is its potential for cash flow. Rental properties can create a steady stream of monthly income, making them an appealing choice for investors looking to build wealth. Many people share their success stories on platforms like BiggerPockets, highlighting how they have developed significant portfolios through smart investments in rental properties. These stories often include details about their experiences, strategies, and the challenges they faced along the way, providing valuable insights for those interested in this investment path. Additionally, real estate investors often enjoy various tax benefits. The ability to deduct mortgage interest and take advantage of property depreciation can greatly improve overall returns. These deductions can lower taxable income, allowing investors to keep more of their earnings and reinvest in their properties. Overall, the combination of physical assets, cash flow potential, and tax advantages makes real estate an attractive investment option for many. Up next is the cons of real estate. While real estate can be a profitable investment, it's important to think about its drawbacks before getting started. One of the biggest challenges is the high entry costs. Buying property often requires a large initial investment, including a hefty down payment, closing costs, and various fees. This financial commitment can be a hurdle for many potential investors, especially those just starting out. Additionally, market risks can pose a significant threat to real estate investments. Property values can change due to economic conditions, as dramatically shown during the 2008 housing crisis. Many investors faced big losses when housing prices dropped, leaving them with properties worth much less than what they paid. Understanding the ups and downs of the market is crucial for anyone looking to invest in real estate. Another important factor to consider is the management responsibilities that come with owning property. Unlike other types of investments, real estate requires ongoing maintenance and dealing with tenants. This can involve routine repairs, handling tenant issues, and making sure the property stays in good shape. Such responsibilities can take up a lot of time and may require hiring property management services, which adds to the overall costs of ownership. Let's shift our focus to stocks, a key part of many investment plans. The stock market can offer impressive returns when approached with the right strategies. Historical data from NYU Stern shows that, on average, the stock market has provided an annual return of about 10% before adjusting for inflation. This figure highlights the market's ability to grow wealth over time, making it an attractive option for both new and experienced investors. One of the best-known success stories in stock investing is Warren Buffett, often seen as one of the greatest investors ever. Through his company, Berkshire Hathaway, Buffett has built a significant fortune by following smart investment principles. His approach focuses on long-term holding and value investing, where he looks for undervalued companies with strong potential for growth. For those interested in learning more about his investment ideas, Buffett's annual letters to shareholders are available on the Berkshire Hathaway website. These letters provide valuable insights into his strategies and show how patience and smart decision-making can lead to significant financial success. This is the pros of stocks. Investing in stocks has several important benefits that make it an appealing option for people who want to grow their money. One of the main advantages is liquidity. Stocks can be quickly bought or sold on the stock market, giving investors easy access to their money whenever they need it. This flexibility is especially attractive for those who may need to convert their investments into cash quickly. Another benefit is diversification. The stock market is made up of different sectors, such as technology, healthcare, and consumer goods. This variety allows investors to spread their investments across multiple industries, which helps lower risk. For example, investing in index funds can give exposure to a wide range of stocks, allowing investors to balance their portfolios without putting all their money in one place. This strategy helps protect against market ups and downs, as losses in one sector may be offset by gains in another. Finally, stocks usually have low entry costs. Many brokerage platforms now allow people to start investing with a relatively small amount of money, often with no minimum investment required. This accessibility means that even new investors can take part in the stock market without needing a lot of money up front. Overall, the pros of stocks, liquidity, diversification, and low entry costs make them a strong choice for those looking to invest and build their financial future. Let's now check the cons of investing in stocks. Investing in stocks can be a great way to grow your money, but it's important to be aware of the downsides that come with it. One major concern is volatility. Stock prices can change dramatically in a short time, often due to market trends, economic conditions, or unexpected news. This unpredictability can lead to significant losses, especially during market crashes when many people start selling out of fear. Another key issue is emotional investing. Investors can easily be influenced by their feelings or the overall mood of the market. Fear and greed can lead to poor choices, such as buying stocks when prices are high during a market surge or selling when prices are low during a downturn. These emotional reactions can derail a solid investment plan and result in missed opportunities or big losses. Finally, investors have limited control over the companies they invest in. As a shareholder, your say in company decisions is very small. Important choices like mergers, expansions, or management changes are typically made by a few executives and board members. This lack of control can be frustrating for investors who want to see their interests reflected in a company's direction. When deciding where to invest your money, it's essential to know the differences and similarities between real estate and stocks. Each investment type has its benefits and drawbacks, catering to different investors based on their goals and risk tolerance. Returns on investment. Real estate generally grows steadily over time, with average home prices in the U.S. rising significantly, as noted by the National Association of Realtors. Conversely, stocks usually offer higher average returns, particularly in the long term, as shown by the resilience of the S&P 500. While real estate may seem stable, both investments can yield good returns with the right approach. Risk levels. Real estate tends to be less volatile, meaning property values don't fluctuate as much as stock prices. However, it carries risks during economic downturns. Stocks may drop sharply, but often recover quickly, driven by market rebounds and innovation. Understanding these risks is crucial for smart investing. Time commitment. Investing in real estate requires more time and effort for management, including maintenance and tenant issues. In contrast, stocks can be more passive, especially through index funds or ETFs, which allow for diversification without constant oversight. Market trends for 2024. For 2024, analysts predict growth in both sectors. Lower interest rates may boost real estate, while the stock market could rise as companies innovate. Staying updated on these trends will help investors capitalize on opportunities. Let's look at a couple of success stories that show effective strategies in real estate and stock market investing. Real estate success. Matt Faircloth. He started his journey with one single-family home and grew his portfolio to over 300 rental properties. In his book, The Ultimate Guide to Real Estate Investing, he shares tips on managing properties and understanding the market. Faircloth also provides helpful information through podcasts and webinars, making his lessons easy to access for new investors. Stock market success. Chamath Palihapitiya. He is a former Facebook executive. is well known for his success in special purpose acquisition companies, or SPACs. He stresses the importance of having a long-term plan and investing in companies with solid fundamentals. Palahapatia shares his investment ideas through interviews on platforms like CNBC and his social media channels. If you're ready to take the next step in your investment journey, don't forget to subscribe to our channel. Check out our next video, How to Retire Comfortably on a Low Income, Realistic Plan for 2024, for practical steps to secure a fulfilling retirement on a budget. Let's build your financial future together.